Good afternoon. Thanks for having me on the panel. Excited to be here. As Steve mentioned, I head up a data science group for American Family Insurance. We are sort of a small center of excellence for that organization. As I'll explain in a minute, the kinds of analytics applications, data science applications in insurance are actually pretty broad. And we do a pretty broad spectrum of work from anything in our sales and marketing group, product, claims, or even tackling a sensing project with our facilities management organization. Just because many of you probably don't know, American Family does not write business in California, at least not through our primary agency business. We are primarily property and casualty insurance company operating out of Wisconsin, Madison, Wisconsin. About an $8 billion company. We do write life insurance as well, but mostly auto, home, and commercial. We operate primarily in the Midwest, but we do have some affiliates of ours that are nationwide. So as Steve mentioned, insurance is, well, actually, let me say first of all, thank goodness insurance is not a business with the kind of stakes that Michael just spoke about. Most of the time, if we screw up a prediction, nobody's going to die. They're likely not even going to get injured in any way. Maybe their pocketbook will suffer a little unduly if we charge them the wrong rate, or maybe they'll get angry at us if we think their claim is fraudulent and it's not. But in large part, the space where our predictions operate is fairly benign. That said, when I think about safety in insurance, I also want to throw in there not just sort of physical safety, but the safety of our business, the safety in terms of societal values, public relations risk, regulatory risk, and all those sorts of factors. So despite the lack of high stakes and exciting applications that involve life or death, insurance is actually a pretty exciting space to do data science, and a lot of people don't know this. Insurance is actually a very long-time data-centric business. The problem is not even people in the insurance industry knew this until maybe about 10, 15 years ago, other than Progressive Insurance and maybe a few others. We have, some of this is just the nature of the product, right? The insurance product is not a tangible product. It's not something you buy off a website or from a person and take home. Certainly not something you're going to take home on a Friday night and crack open and enjoy over a bottle of wine, like a new iPad. So it's really just a promise, right? And it's a promise, the cost of which is unknown at the time you make that promise. So that lends itself to a lot of rich sort of stochastic data exploration activities. But it also is good for data science because we have deep relationships with customers. Maybe not as deep as we'd like. People don't necessarily enjoy thinking or interacting with their insurance policy, but they nonetheless are forced to over long periods of time. They stay with the company that they purchase, typically for 5 years, 10 years, maybe their whole lives. And so we see lots of data about our customers over extended periods of time. And then if they happen to have an unfortunate event and file a claim, we also get to learn lots about that customer and intimate details about their home, how they drive, or their business. So just a good sort of playground for data science. So what I thought I'd do today is first just kind of ground you all in terms of what sort of data science applications are in insurance, and then talk a little bit more about some of the social, ethical, or safety issues that lie within. And then, of course, no conversation on insurance and ethics or social issues would be complete without at least a small overview of insurance regulations, because that is a big part of that industry. So what I have up there is kind of the insurance value chain, so to speak. So just to give you a sense of what goes on in insurance, right? So we go out and we market to customers either through our exclusive agents, independent agents, or websites, things like that, create awareness and try and get insurance or customers to buy. And then, of course, we spend a lot of time servicing those customers. The big sort of three chunks of insurance that most people think about, though, is kind of the second half of that value chain, which is having a product for those customers, pricing that product, underwriting, so making decisions about will we accept you as a customer or will it be with certain restrictions, and then finally when you have a claim. So just some examples within the awareness and purchase, very traditional models here. As a start, this is actually a space where insurance was not heavily focused for many, many years, mostly because outside of Geico and Progressive, the rest of the industry was pretty much writing through agents. And so we viewed our agents as our customers and did not invest heavily in marketing or studying our customers' behavior. We left that to our agents. But over the last 10 years or so, that's definitely bumped up. So, of course, marketing mix and prospecting, lead generation, sales performance, so studying performance of our agents. So trying to predict, for example, which of our agents are going to leave and go right for a competitor by studying indicators within their book of business. Within the customer sector, recommendation engines. So those have definitely gained some traction in insurance. A lot of the traditional things you'd think about around satisfaction, segmentation, lifetime value. Virtual assistants has definitely grabbed hold of the insurance industry. We've got several bots in place across our organization, as do pretty much all the top 10 carriers and probably more. Within the product space, pricing is really the heart. So things like telematics, usage-based insurance, pricing you based on how you drive, credit scoring, things like that. We do a lot around trying to predict profit because we don't know the cost of that policy when we sell it. We've got to do a lot to try and predict what we think it'll be. So we spend a lot of time there. Image recognition is also gaining hold in insurance. We write a lot of properties, and so we spend a lot of time studying aerial imagery or drone imagery around the condition of those properties. Or even people's faces and trying to predict how old they are, whether or not they smoke, or what their BMI is. And then the claim side, this is really, so for every dollar we collect, there's 60 cents roughly that we pay out in claims. So this is a huge part of our business and a large operational component as well. So the big class here is around claims risk. So trying to predict how big a bodily injury claim will be so we can triage that claim to the right adjuster, especially if it's a very complex case. Or things like legal risk, which claims are going to go to litigation, when are we going to get sued, or claims that are fraudulent, trying to identify those. Then a lot around operations, so capacity optimization for claims adjusters. And then, of course, weather. We spend a ton of time. We've got teams that try to predict likelihood of storms passing through a certain area or the likely damage to result from those storms. So a good sort of breadth. Just to hone in on a few examples in terms of some of this social or safety risk, virtual assistants, some of the things we might face here, regulations are heavy in terms of products that are offered and coverage customers have. So what if a bot predicts or offers the wrong coverage or answers a question incorrectly around whether or not you're eligible? Within claims risk, a big example here is fraud. So we rely on adjusters to identify fraud when we train our fraud models and to refer claims that they think are likely. And we use those as labels in part when we build fraud models. Well, if there's bias in how those adjusters are viewing their customers, maybe that live in certain geographic areas or that possess certain demographic characteristics, of course, that bias will flow into our models. On the pricing side, things like credit scoring or other demographic characteristics are used. And regulatory agencies, of course, spend a ton of time scrutinizing our work here in terms of the data and the models that we use to make sure that we're not unduly or unfairly treating certain demographic groups. Telematics. Here it's kind of maybe on the flip side, we're trying to actually promote safety. So you put a device in your car through gamification or better rates, encourage people to drive more safely. In the image analysis space, an example here, we recently tackled a project to try and predict BMI through selfies of a face. And of course, one of the issues you face here is skin color of different populations. And so you've got to do a lot around how you train and how you test and validate and study output of those models to ensure that you're not biased against certain groups. And in the marketing and customer space, many things here, social media, trying to predict satisfaction using voice or natural language processing. Well, different populations, different groups across the company speak differently. And that might lead to different predictions in terms of service. So many ways that sort of social and safety risk enter into insurance. And then a quick blurb on regulation. So insurance is very heavily regulated, very similar to banking and utilities. And it's pretty much all done at the state level. So every state is almost completely different. There's a lot of similarities, but not structurally. Different states can regulate insurance very different from even their neighboring state. And that's done by state insurance departments that are led by commissioners that run everything from financial products, operations, licensing, and consumer affairs. Really the purpose of regulation, that first one is really the key, where we spend most of our time, probably 90% of our time we spend with regulators is over that very first bullet, to protect consumers. And I'm getting the time thing. Let me just say, in terms of protecting consumers, 90% of that focus is really around rates and underwriting. So we can't do much that's truly trade secret or non-public in insurance in terms of rates. Those are all filed. Credit scoring algorithms, usage-based insurance algorithms, or other things, you can apply for trade secret status, and most of the time you'll get that, but not in every state. So much of this is public. And so a lot of the sort of secret sauce is how you use that with your customers, how you use that within your organizations, because the rates you charge and even the data that was used, and in some cases the algorithms that are used, are public information. And then market conduct is another big one. Consumer files a complaint about how you handled a claim or the fact that you non-renewed them. That can result in the insurance department sort of very formally following up with that with your company. And if they don't like what they see, that could in turn lead to what's called a market conduct exam, which is kind of the sort of, can be sort of a shameful process in a sense that if you're getting that as a result of a consumer complaint, that's probably not a good thing, but definitely can happen. So with that, I'll turn it over to the next speaker. Thanks.